Hello, everyone, and welcome to BFW 2401 week 4. This is the second part of analysis of bank performance. So in this part, we have only the calculation, which is not much. The material is we have 40 slides, but actually it's easy to go over. It's about ratios. Maybe we have something called the ROE model or the DuPont model. It's the only maybe new things to some of you. The rest are just a very normal stuff. So what I will do now is just, I will share my screen and go over that. And hopefully I will go over it in reasonable pace. Okay, so now this is part 2, and we are talking about, so the blue font is actually what we are going to cover. It's the ROE model, bring some example, and we'll talk about the other key issues, key ratios that complete the analysis of bank performance. This part, we already talked about it. And this part is only one, the new measures, it's only 2 slides, not a big deal. And then we will jump to the conclusion. Now, the DuPont model, excuse me. Sorry. So the DuPont model is actually coming from the what we call the ROE model. So the DuPont analysis is based on the ROE model, and actually it starts with instead of having all those ratios in different categories and in different areas which you cannot connect. The DuPont model, the purpose of the DuPont model is a 3-factor model, which means it shows you how the ROE of the company is coming from where. Now, so it's a function of 3, other ratios, and this is why we call it 3-factor model. It can be a 3-factor model, and it can explain where the return on equity coming from. Now, it's based, as I told you, users, it uses return to shareholders based on ratios, bring detailed data to explain observed changes in financial ratios. I'll explain all of this. Actually, all of this will bring to structured discussion. And as I told you, it starts with the ROE, which is the final purpose of the company. Now, the DuPont, the analysis, it breaks down the ROE performance into its component. And basically, when I say 3-factor model, you have the ROE, which is a function of the profit margin, function of the asset utilization, how we are going to use our assets, and how efficient we are in using our resources and create revenue out of that. Profit margin, which is the first one, is how we are controlling our costs. So we need higher net income. And the third one is the leverage, which is the asset utilization over the asset, what you call total asset over equity, and which means how much capital we are using. Now, this is actually the 3 factors. Now, if you look at it, it's here. Now, what I want you to know here in this stage at least is to understand that the DuPont model is actually, this is, the DuPont model should be only this one. The one that is not covered, which is the ROE is actually a function of the leverage multiplier and the ROE. Now, this one later on, which is the ROE, is broken down. I break it down to asset utilization and net profit margin. Now, what I want to understand in this case, in this stage now, is to understand, as I told you, is to understand actually the measurement, which means the measure of all those things. So we understand now the ROE is actually measures the return to shareholders, and the leverage multiplier, and we want this as much as high as we can. We want it higher. This actually is the main component in this ratio is the equity. It's not the total assets, the equity. So the equity problem here, if you can decrease it, you can increase this ratio and increase the ROE, which comes to the question is how much equity I need. In other words, how much capital I need. Decreasing it all the time and as much as I can, it's not a good idea because that can make me very leveraged, less capital. When any small problems happen, they don't have enough capital to buffer those losses. Okay, now this is just, out of the mind now, before we go to the deep discussion about that. Then we have the ROE, which is the net income, which measures the overall operating efficiency. And this operating efficiency is based on two things. Am I using my total asset to create enough revenue? So I want this higher. Am I controlling my costs and am I efficient and effective in terms of, so this is the net income actually is the real number we are looking for it here. The revenue is the real number we are looking for it here. So we want to see how the net income is generated. And it comes, and we can increase it if we control the cost. The cost of goods sold, the admin cost, all those things come under the revenue, which is the cost, is actually the function of this ratio. This will bring me the revenue. So the most important thing is here the revenue. The most important here is the net income, which means my net income to my revenue is how much. I can have high revenues, but less net income, which means there is a problem in the spending, okay, and in my cost. It's not always, getting too much sales. That doesn't mean I'm very profitable. It only means that I'm making more sales. I'm making a lot of loans, getting more income. That doesn't mean I'm okay. It means I'm okay if I am controlling also my costs. So if I come here to this formula, now this formula is actually this side, as I told you, this side, 1, 2, 3, which is the ROE is the leverage, the ROA times the leverage. I just multiply it here, which is before I break the ROE. This is the formula. So as you can see, this is a return, which I wanted higher, but this is a credit risk. It can be a credit risk. It can be a credit risk. It measures the efficiency, but I can increase this ratio on the expense of credit risk. What do I mean? I mean, I can increase actually my net income here. And when I gave loans, customers are very happy. I mean, during the first, before any economic cycle happened, before any shocks to the economy happening, like what happened during the financial crisis, the subprime was good people. I mean, not really good people. They are good people anyways. I mean, they were not really good in terms of financial issue, but in terms of humans, everybody is good. Anyways, what we are saying here is the subprime during the financial crisis who were not qualified for the loans, actually, they were okay during the first year. When they started in 2001, 2002, they were okay. Only when the interest rate increases and the economy started to, especially when it started the interest rate increases, it becomes costly for them to hold these loans and they cannot pay it anymore. So in this case, they are not really, the partnership with them was not really a strong partnership that takes to consideration the reflection of the economy, the reflection of the different status of the economy. So what happened is you can increase the net income for the short term. I'm saying this because you can increase the net income for the short term. I have a loan of 30 years. I can increase the net income for I can get interest income for the first year, second year before this bad loan or less quality loan defaults or the customer cannot pay. It's like when you buy a car. When you buy a car, the first year, the first 6 months, everybody will pay. Later on, in the years later, if this loan is 9 years, it's highly, if the customer is not good, it is going to be defaulting. So this is what we are saying. So actually, increasing this number is good, but that doesn't mean every single loan that creating interest rate income for me is a good loan. So it may involve some credit risk. Now, this one is, as I told you, the main point here is the equity. I can decrease this as much as I can, and I can decrease it to increase the return on equity by decreasing this equity, which is the capital, and this will make me very, very, sensitive to any drop or losses. I will not have any buffers and any capital to buffer any unexpected risks. Okay. Having said this, now this is I think the most technical thing in this issue. So let's look whether we can do an example using the ROE. So we collect data. So I bring you some data here, and we calculate the ratios, and we identify the as I said, identify the linkages and look for, and then we have to compare all of this with the other, the other indicators, which is external indicators. Either those external indicators are quantitative or qualitative. So this is I get from inside the company, and actually it's based on the numbers in the financial reports now and in my financial in my books. But now, later on, I have to look at the share market data, credit rating, financial indicators, and the other measures of performance, and calculate the growth rates and the market share. If I am going up in this, if I have a trend with the ROE is going up, all of those should go up. If all of those going down, or some of them going down, especially the market share price, and the ROE is going up, then actually there is somebody is cooking those numbers, or there is some problem. Maybe there is so much risks involved in those loans in a way that the investors already know, and they are so scared. So in this case, they are increasing their rate of return and cost of capital to you, and therefore, when they price your shares, the discount rate is high because that discount rate is involved actually your risk. So because the price, if you look at the price, just to make it like this, the price is actually the cash flow, as we said before, divided by the 1 plus I, right? Now this I, as I told you, it will incorporate the risk. The I will incorporate the risk, the discount rate. So if you look, the market share is going down, if it is really going down while the ROE is going up, that means you are giving bad loans, and those bad loans are creating for you income in the short term, and they will be in the long term, collapse. Investors are smart, and those are institutional investors with they have the expertise to know, they understand what's going on, okay? So if this is going down, or people or regulators are not happy with you, investors are not happy with you, all these things, still you do very well here, there is something wrong with your numbers, okay? Now let me come to here, okay, so this is what we are talking about: collecting data and calculate ratios, identify, and then and to complete, you have to do these things. Now let's look at this data. This is just easy. It's actually all data 2005, 6 They make it 2019-20, but it's still real numbers from. So it's actually the. So this is the numbers. This is 2019, 2020, and we have a balance sheet, a simple balance sheet and simple income statement. A normal one, we have in the balance sheet the cash, the loans, the we have here the current debt, long-term, and equity. Actually, this is what we are interested in, the equity and the loan sales when it comes to the issue of the DuPont model. And here within the net income, and we need the revenues. So I will start calculating now the components. As you can see, I can calculate the revenues. I can calculate the net income. I can calculate the assets and the equity as averages. So the net income is interest revenues minus interest expenses minus the, which is this numbers. So the total assets, we take averages of the 2 years. For 2019, we cannot take average because I don't have 2018. So I take only average for 2020, but usually we have to take the averages. Anyways, this is what I have. This is the industry average, which is the performance. The black fonts is actually the performance of the 5 top banks. This is an Australian example. So they are taking the top 5 banks. I will show you the names of them. And this is my analysis for 2019. And I get the ROE, which is 14%. To get the 14%, of course, ROE is what? Net income over. So I have then the equity is 10. And the net income is this number. So if you divide this, it's 14%. And you can continue with those. So the average multiplier is 13 times because we have, I think, total assets of, we have total assets of how much? 130 million, I think. Yeah. And then we have the equity of 10. So we divided this 10 by 130 by 10, it will become 13 times of. So this is what we are doing. I can continue with this ones. The interesting thing is that I'm doing better than the industry. I'm doing well in my return on equity. I'm doing well in the leverage, which means my capital is reasonable. It could be some risk there. I'm doing well in the ROA. I'm doing well in the asset utilization. But I'm not doing well in the net margin, which raises now a question. What's happening? Maybe my control of expenses and the cost is not good because the net margin, net profit margin, asset utilization is a measure of how we are, how much we are making revenues and how effective we are and efficient we are, how effective we are actually in increasing the business. But the net margin is how efficient we are in using our resources and controlling the cost. So now if I bring it here, and this is the top 5 banks, we have ANZ, Australian New Zealand Bank, Commercial Bank of Australia, NAB, St. George Bank, and Westpac. Usually we have 4 banks, but now we include also the St. George Bank. Now, the ROE, as I told you, I'm making 14, the industry 13.9. I will ask why. This is one question. So we'll start it with the questions here. Because it could be I'm performing, it could just be an actual thing, a real thing that I'm performing better. And so we ask why. The leverage, we are less. There is possibility that I'm trying to decrease the capital and I'm riskier in this issue. You need more analysis to see whether this capital really enough. Okay, we are greater here. which is good news. And we are less here, lower here. As I told you, we have to investigate this area. What's the problem? Why our net income, which means our expenses, including the admin expenses, is high? Okay, this is one of the things that we have to understand. Now I can go to the ROE, and it's above the big five. And actually it's about, if I want to know why, I have first to analyze those two ratios to say why the ROE is high, okay? And this is easier to analyze. Okay, now if I compare the trend between 2020 and 2019, I'm doing well in 2020. As I told you, this is not the, these numbers was 2006 and 2005 to 6, so I've dated 2019-20, but actually the number is still there. So somebody will say, oh, the COVID was here, this company is making better. This is just a hypothetical example. So the ROE is 14.2 in 2020. We have leverage multiplier or 13. We have here 12.7. Which means I'm doing, actually 2020 is much better than 2019, which is a good thing. Maybe there is an increase of the, this is a normal thing, which means there is growth and there is more profit and there is more market share, and it's, you know, a time function. Okay, but now, the leverage multiplier, as you can see, have dropped by another drop by 30 basis points. So maybe the 13 is okay, and we keep decreasing our capital, maybe because we are efficient, or maybe because our loans are better and high quality and our risk is less, so we need less capital. Still, all of those are questions. Still, all of these questions. There is an increase a little bit here in the, there is an increase here in the, as I told you, in the ROE. There is decrease in the leverage. There is increase in the ROE. And then the asset utilization is 397, which is actually 2020 is better in everything you can see. So asset utilization is high and net profit margin is actually even higher. So the question we would ask, for example, like have the, you know, some of the question is when we see the increase of 12 basis points here, have the asset interest rates risen? Has the mix of asset moved to high credit risk? Has the non-interest income increased? This is some of the questions just to answer why the revenues are increasing, because this formula, this part, this ratio is revenues over total assets. So you want to see why the revenues actually have increased. Is it because I'm increasing the rate of the interest, or because I am having more credit risk? Because I'm increasing, just giving more loans, and this giving me more revenues. Some of these revenues can be cash revenues, and some of them can be accrued. Okay, this accrual means not collected yet. Here, have the cost decreased? Why we are decreasing here? Have non-interest cost fallen? Is it a drop? Because we used to have 28, now we have 28.3. We believe that 2019 was okay, and there is an increase of 3 basis points. This is maybe because the cost is decreasing, or maybe the our expenses of non-interest income dropped, or maybe there is low taxes. All of those questions and other questions should be asked. This is why we are saying now, the first thing is to take the model, collect the data, do the ratios, start ask questions and make linkages, and then compare it to the other factors in the market, like the market share. If everything is going in parallel, which means they are consistent with the internal data through the DuPont model, revealing information and performance consistent with the outside performance, like the share price, like the other qualitative issues, like the rating agencies, then we are actually fine. That's the whole thing about it. Now we can go now to other key ratios, and it's not actually very technical now. We just will talk about bank efficiency. This is another ratios we use, and they have purposes. Some of those ratios, we will talk about it in the future. So first one, we will talk about bank efficiency, which is the net operating income over the number of employees. And this will actually, those three ratios will measure how efficient I am. So cost to asset ratio, which is operating expenses over the total assets. And then we have the efficiency ratio, which is operating expenses over operating income. One of the things that you want to know is this ratio is better lower to be low or better to be high. So this, for example, the operating expenses fee of the total assets, I want it to be as low as possible. So I want this to be low as much as possible. Operating expenses to operating income, I want it also to be low. Net operating income over the number of employees, I want it also to be less, because this means the this I want it to be high, because the net operating income, we want to see how much each employee is actually creating. So I want this to be high, and this is to be low, and this is to be the other ones to be low. So I want this to be high, which means how much each employee is creating for me in terms of profit. Okay, this is the interest, and the interest is how much we give our loans, what rate of interest we are granting our loans, and how much we are giving to our depositors. So actually there is a spread between the two, and actually we want them to be as much as we can, because that increases our profits and our net income, and in a way that keeps our competition, a competitive advantage, and our market share, and keep our competitive position at least consistent. I mean, not taking over by the competitors. So we have to be careful about the interest, how much interest we charge. Sometimes we charge more interest, and that will lead either the customer will run away, or the customers will default later on, and we have credit risk. So also how much we charge is another issue, and how much we give also another issue. But whatever we are doing here, we are trying to see how much we are making in dollars. So we want to see how much the interest income and the interest expenses are doing, and this is what we call the interest differential, which is actually our income. So the net interest income, dollar interest income, is you take interest and minus interest expenses, and then we can also compare it to percentages of interest spread. So the interest earnings, which means how much over the interest earning assets. When we say interest earning assets, is the loans or the investments. Any asset, we are not talking about buildings, we are not talking about cash. Anything that does not earn, we are not including it here. We are only including any type of asset which is actually the loan and the investments, minus the interest expenses, interest-bearing liabilities. The interest-bearing liabilities is those liabilities that we pay interest for. So we need to know the percentages of those two. Now, percentage of interest margin, net interest margin, which is interest and minus interest expenses over the earning assets. And this is will tell me actually the margin. Risk measurements. Yeah, we have so many risk measurements, and we will start with the interest rate risk. And actually, we know this ratio very well. We dealt with it in week 2, and we are talking about the interest-sensitive assets over the interest-sensitive liabilities. This could be one, more than one, or less than one, but I cannot tell you which one is which one should be higher or lower. So there is nothing called higher or lower. It depends on the movements of the interest rate in the market. So if the interest rate depends on my gap, as I told you before, and then the movement of the interest rate in the future, that will determine which percentage, which ratio I want it here. Do I want it to be 0? You want it to be higher than 1 or lower than 1, as we have discussed through the interest rate. So the interpretation, the ratio is 1, means RSA equals RSL. So the change in the interest will affect both income and expenses. We know this. Two effects will tend to offset each other. So the net interest income will remain largely unchanged if we have 0, if this one is 0. So interest rate risk or the repricing risk will be minimized. We are talking about 0 exposure. Now, this is the credit risk, and the credit risk means how many loans we just take off out of our, eliminated from our books, because there is no way the customers will pay, and the name of this is the write-offs. And the write-offs happens because of the loan staying long time and nobody is paying. Keeping it there is just misleading to the investors and to the regulators, and therefore you have to write it off. Or maybe you went to there is a big business loan or huge business loans, and then you have a problem. You went to disagreement with the customer, then you went to the court, and the court case was in favor of the customer. And in this case, you are not going to get anything by law, so you have to write it off. So this is what, so it's actually all of this, the write-off, this is one measure of credit risk, is actually a credit risk. Now we have liquidity, and liquidity is actually, of course, with this ratio, I want it as less as I can. I want this to be very less. But this one, I don't know. It's not I don't know. I need more information to know how much liquidity I should have. And it depends on the unexpected withdrawals or the customer. Do I want it to be down? Do I want it to be down, or do I want it to be high? It's another issue. So do I want this to be actually higher liquid asset is not a good thing. But then lower is not also a good thing, which means you need more information to decide, because lower can be risky, but more profit, and higher can be a problem with efficiency, not efficient. You are not using your assets and you are utilizing your assets as you are supposed to. So you'll have low asset utilization. So, but how much you should keep, it's another issue. You need to make modeling for liquidity and expect how much liquidity you will have. And this we'll discuss in the future. Now, this is the risk management, which is, this is just the return on equity actually. But we have two measures. We have shareholders funds over total assets. And we have the risk-weighted capital asset, which is qualifying capital. This actually is related to what we call Basel. Now, Basel is dealing with this number, and we have to calculate it according to Basel. And this is what we call the risk-weighted capital ratio. And this is what we call the symbol ratio. Symbol ratio is just the equity over the total assets, which banks used before Basel. Now, because the capital is, the purpose of the capital is to buffer risks. Not every asset has risks. So what Basel did is just they come with something called risk-weighted assets. So they classify the assets according to the risks. So if you have $100 investment and government security, government will not default and you will get your money. So it should have a zero weight. But if you are taking a housing loan or you are working in derivatives, maybe you need 150% because 100 is to cover it and 50% for the other problems in the courts, because you can go to the court and spend so much money and then don't get even the loan. So some of the weights even 150. So anyway, what I want to say is this is, they bring the risk of each asset. Here, no, it's just one simple ratio. They bring the total asset as they are. Shareholder returns. This is the price to equity, which we know it. It's a big measure in finance, in corporate finance specifically. And to look at this, when I invest in some type of equities in any company, I buy the shares of those companies. I expect two things. One of the things is they pay me dividends. And the other thing is I'm expecting some type of increase in the price. Both of them is actually the return. Look at this example. If I bought, this is how they, if I bought a share for 21 and share price was later on 25, and during this period, if I keep it for 1 year or 2 years, whatever, or maybe say 1 year, they pay me 120, which is the what you call dividends. So my return is coming from dividend yield and capital gain. Let's look at dividend yield, which is 120 over what I invested. It's 5.7. And the capital gain is 4 out of the 21, which is 19%. All of this is actually my return, which is the 24.8. This is what we call the return, shareholders' return. There is another thing, which is also the growth. So the growth here is you just take the last year minus this year, and you want to see how much your assets are growing, which is a very, very important indicator for banks. So in this case, I'm taking this number. So my total asset here was 130. In 2019, 130. And it becomes now 133,500, which means there is an increase. I want to see how much that increase, and I compare it to the growth of the other banks or the averages of the other banks. So if you look at here, it's 2.7. Now, some question I have to ask is, how does this compare to the GDP growth of the economy? This is one of the questions that you may want to ask. How does this compare to the previous year? Is it the same or less? Less is not good. How does this compare to the other banks or the industry average? And if high or low growth, does this reflect more or less risk taking? So because sometimes I can grow high, but because I'm giving more loans, increasing my total assets, and those assets and those loans mostly will be toxic loans later on, or maybe will be bad loans. I'm just inflating my investments for nothing, increasing my assets for future risk. Now, I also want to see my market share. This is very important. So you will take, this is 2020 according to the numbers, 133.5 over the total asset of the whole industry, which is the other banks. And I want to see what is my market share this year. And whether this market share in terms of total assets is growing or going down. If I can know, then if I'm going down, maybe there is a booming in the economy, and the country is, the economy is stimulated, and there is growth, high growth in the economy, and this growth is 7%, 6%, like what we have seen in China or other places. Even in Malaysia, we used to have 8% during the early good days. Now, this growth is actually will be reflected if I'm growing less than the economy, or growing less, I'm still growing, but growing less. If my market share, if there is a growth, there is higher market share. If my market share is decreasing comparing to the others, then there must be some problem because of this growth. So I have to look to my market share and compare it and watch it, whether it's increasing or decreasing by time. Now, this is one slide to see the agenda for other approaches. The concept is behind this issue, behind the new measures is, look, if I have a revenues, that revenues will cover my cost, which is the deposits return. If I pay, for example, if I take 10%, and that 10% is actually, I pay my cost for the depositors, say 8% or 7%, and then I have 3%, I cover all my other costs, and then I have a net income, and that net income, I will divide it by the equities, and I will get return on equity, which is earning per share. Now, this return on equity, if it is exactly equal to the cost of capital for my company from equity, then I'm not growing, which means dividends should go to whatever left is actually exactly the cost of capital, which means in this case, I'm covering my cost of debt and cost of equity. If I exceed that number, I have an economic profit. This is the whole point. So if I have an equity, if I can cover my cost of debt, if my revenues can cover my cost of debt and cost of equity and still have surplus, I have an economic profit. This is the whole thing. Let me show you this. So we have two measures, AP, which is economic profit, and LORAC, which is the risk-adjusted return. Look to this example. So the AVA, which is the economic value added, is net income minus expected loan losses minus the cost of capital. This is net income already after I deduct my cost to it's the net income, which is the bottom line, which is when after I take all the cost of debt and all these things. I also have to deduct any expected loan losses and decrease the cost of capital. If I still have here a positive value, then in this case, I have actually an economic return, an economic profit. Look at this. If the bank pre-tax cost of capital is 30%, and he has two loans, loan A is 8, risky, and loan A is risky and needs $8 of capital. Loan B is low risk, but needs $4 of capital. Now the loan A cost of capital is 2.40 times, which is 2.40, which is the 8% times 30. The loan B cost of capital is the same cost of capital. I have the $4, 30% of this, $1 is 120. Now loan A will add to the shareholders' value if the net income minus the expected loans exceed 2.40, because 2.40 is the cost of capital. Loan B will add to the shareholders' value if the net income minus the expected loan losses over 120, which is this one. So if you cover, which is this formula, net income minus expected losses. If this exceeds the cost of capital, then it's we are okay. Okay. The other one is the LORAC. LORAC is you take the net income minus the expected loan losses divided by the allocated capital, which means it's still the same. I will take the net income for a loan portfolio minus the expected loan losses. So, and I will see how much risk is actually there, and the risk is the allocated capital. So the allocated capital, which I will buffer this for this net income, is actually will tell me the, so if the LORAC here requires rate of return, so this will give me the rate of return. Now the rate of return of the LORAC, if it is higher, like what we do in the EVA, which is this one, the economic added value added, if we have the LORAC higher than the required rate of return, then in this case we have what we call an economic profit. I am done almost. So this is just to slide fundamental questions. Has the shareholders' value been maximized? So the good financial analysis, which means this is our goal. This is always our goal, to see the shareholders' value maximized. Good financial analysis should include verify the data, look to the accounts, notes to the accounts. This is when we talk about financial reports. Our ratio analysis should be based on ROE. Share market indicators should be taken to the picture. Other measures of returns and risk should be also included. So we have to measure risks. Off-balance sheets should not be omitted. And qualitative indicators should also validate what we are getting here. So qualitative indicators should actually validate the quantitative results. Good financial analysis also requires comparative analysis, which we have to compare with our performance and with our peers and with our targets. And we have to ask always question of why ratios has been changed. Look for linkages. So to dig down for some risk or some, normal things. I am done. There is nothing here. This is just telling us this. There is a difference between the short term and the long term yield. Even when we talk about the risk-free, if this is the years, we have risk-free going up. When we have risk-free return for short term, it's higher than long term. And also our spread is what? Just for the, by the way, this is just for information. It's not required in the exam. This test or the next test. Just for your information. So if you have the credit risk spread here, 105, this credit spread is actually by time. See the yield curve is increasing, and the credit asset spread is actually in this stage is 1.5 because the risk-free is increasing and your spread is decreasing by time. Okay, if it is a fixed loan. Okay, this is a 5-year loan, and as you can see, this is the maturities. This is just some other data. All those, as I told you, the KPMG and the others, and the EPRA always, this is KPMG reports. They report about all banks around the world. This is about the Australian banks. So I am done. Let me just stop this, take it easy for this, just concentrate in the ROE and maybe the other ratios. I already reflected those questions in the tutorial. The other ratios, the other key ratios, or the ROE, and hopefully we will have good tutorial and see you there. And let's hope a good week. Thank you.